Welcome back to Storm Stock Solutions. I'm Grant Mercer. The closing bell has just sounded on Wall Street, and today was all about the bond market tightening the screws ahead of a big Fed decision. Stocks chopped around as long-term Treasury yields pushed higher, mortgage rates jumped, and you could feel a little more nerves creep into risk assets, especially around crypto and anything that's been running hot. Let's start with that macro shock absorber, rates. According to reporting from MarkWatch, long-dated Treasury yields climbed again today, even as the market is still pricing in a Federal Reserve rate cut on Wednesday. Bond investors are calling this the disappointment phase of the Fed's cutting cycle. In other words, traders may finally be accepting that even if the Fed trims the policy rate, longer-term borrowing costs don't have to follow them lower. That's critical for equity sentiment. Higher long yields can pressure growth and tech valuations, raise financing costs, and tighten financial conditions just as investors were hoping for a sustained easing cycle. It also undercuts the political goal of cheaper borrowing across the economy. And it's one reason you saw such a cautious tape into the close. You can see that same theme spilling over into housing. Another MarkWatch piece highlights that mortgage rates are actually surging ahead of the expected Fed cut. That disconnect, Fed easing on the one hand but mortgage costs jumping on the other, is a reminder that the 10-year yield and mortgage-backed markets, not just the Fed funds rate, drive what homebuyers feel. For the broader market, it raises questions about housing activity, consumer confidence, and how much support the real economy will really get from this next phase of Fed policy. On the downside and risk front, crypto was once again in the crosshairs. A deeply reported story on Bitcoin's November crash argues that the drop was no accident, pointing instead to an always-on hype machine that boosts prices, then blames macro when the air finally comes out. For markets, the lesson is less about Bitcoin's exact level and more about fragility in speculative corners. When liquidity tightens, these pockets can unwind fast, and that can spill over into broader risk appetite, especially for high beta tech and smaller cap names. Staying with the caution theme, another piece from MarkWatch's Mark Holbert digs into investor sentiment and bubble fears. Historically, bearishness itself has often been overdone. Markets have climbed plenty of walls of worry. I have. But what's notable is that before prior major bubbles burst, like .com and housing, there was actually widespread concern about valuations and risk, just as we're hearing again now. That doesn't mean a crash is imminent, but it does tell us that professionals will be watching whether today's worries are just noise or an early warning that pricing in some corners has stretched too far. We also saw individual stock-level pressure in the chip space. Reporting on Marvell Technology points to new concern over its competitive positioning with key hyperscale customers like Amazon, and its ability to fully capture opportunity with Microsoft. When the market is already anxious about high valuations and rising yields, any perceived crack in a growth story, especially in semis and AI-adjacent names, tends to get punished quickly. That's another area traders may handle with care in the near term. Now, not everything on the radar today was about red screens. In the background, there's a quieter rotation conversation going on. One under-the-radar piece from Paul Brandis looks at moving money out of U.S. stocks toward international markets, echoing some of the positioning talk you've seen around Warren Buffett's moves. That's not a recommendation, but it's a reminder that global diversification and relative value between U.S. and non-U.S. markets are back on the table for many asset allocators as they think about 2026 and beyond. There were also some personal finance angles that, frankly, matter regardless of where the S&P closed. A feature on young men choosing Bitcoin over 401. Case for retirement highlights just how polarized the approach to risk and long-term planning has become. At the same time, stories on couples coordinating retirement and how athletes or lottery winners handle big windfalls all point to the same underlying theme. Planning, discipline, and communication often matter more than chasing the hottest trade. Professionals watching these trends care because they feed into savings rates, flows into traditional markets, and the demand side for risk assets over time. So as we wrap the day, the through line is this. The market is running into a more complicated rate environment just as the Fed is supposed to be, helping, and that's exposing fragile spots, from speculative crypto to richly priced growth names, while fueling deeper debates about bubbles, diversification, and long-term strategy. Looking to tomorrow, the focus stays squarely on the bond market and Fed expectations. Traders will be watching whether long-term yields keep grinding higher, whether mortgage rate pressure keeps building, and how that backdrop shapes positioning ahead of Wednesday's decision and press conference. We'll also be watching for any follow-through in crypto volatility and tech weakness as sentiment digests these macro crosscurrents. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.